Hello, friends. Welcome to the Weekend Investing Daily Bite of 19th of May. The market continued to be strong. Uh, Large caps gave up some gains. Sectors like defense took some profit booking, but many new sectors are opening up, and market doesn't seem to be giving up. Today's topic of discussion is on gold. So, gold is great for non-USD investors. We'll see this differentiation of what gold does for US investors and what gold can do for non-USD based investors like us. That's the second half of the video. Uh, do read the disclaimer fully and do subscribe to the channel, please. Where is the market headed? Market for the second day was in a soft situation, profit booking little bit, not going anywhere, minus 0.3% for the Nifty. Nifty Junior, however, was up nearly half a percent. See in the chart that it was up yesterday also. So while Nifty has been softening for 2 days, Nifty Junior has been going up for 2 days. So there is certainly a divergence which is happening in Nifty stocks versus rest of the market. In the Nifty, in the mid cap space, also a new recent high was made, up only 0.16% at close, but during the day, much higher levels were also there. And in the small cap space as well, there was gains at plus 0.68%. So minus the Nifty, for the last two sessions, the rest of the market has been going up. So the underlying strength in the market certainly is there in the breadth. Nifty Bank also popped up but gave up most of the gains towards the end, plus 0.12% for Nifty Bank. It is still maintaining that very nice flaggish like uh, formation here. Gold is hugging uh, this moving average, not going below 9,300 mostly on the INR, closing at nearly 9,400 per gram as of 4 p.m. on 19th of May. Gold is actually looking bullish to me. US yields are all up nearly 5% for 30 years. And Japanese yield is also up, I think like 18-year high or something like that. When yields are going to be this high, it basically means that the bond market is calling the central banks and the Fed's bluff that they can take the rates down. So while Fed has been cutting, it has cut twice. The yields are still going up. So the market is not, yielding to the command of the Federal Reserve, and essentially at some point of time, either the Federal Reserve will have to throw a lot of uh, uh, money at the bond market, where the Fed itself will have to buy significant amount of treasuries, as foreigners are not buying anymore. Japanese central bank is selling, China central bank is selling, and other central banks are not buying with that kind of a demand pull. So where does the demand come from for US treasuries? And unless there is demand, which is going to take bond prices up, yields will not come down. So some demand has to be created. If it is not external, it will be created internally. If it is created internally, a lot of money will get generated out of thin air, and that will also lead to more inflation, for which already the yields are pricing that in. So it's a very tricky cash 22 situation, and equities and gold should perform if that kind of a deluge of money is coming to the market. Advanced decline trends were almost, I would say, slightly better than even for the advances. You can see that while the advances were very good in the first half of the day, they did decline towards the end. So second half was more of declining of advances. So maybe market needs more rest on the Nifty 500. In the Nifty heat map, you can see Reliance, Infosys, TCS, Wipro, all really going down. You also had Zomato, or now Eternal, going down. Tata Consumers was down, and you had Hindalco also go down 2.75%. Others were reasonably flat. There was a pop up in Bajaj Auto and Shriram Finance. In the Nifty Next 50 space, real estate took a frontal lead today. DLF, Lodha, these stocks were up. Hyundai was up. Divi's Lab was up. JSW Energy, Gas Authority, IRFC, Bajaj Holding, these stocks were up. Adani Ensol was down along with HAL, Naukri, and Pidilite, and some other stocks. In the sectoral trends, you can see that there was a nice gain in real estate stocks, as I was mentioning, 2.3% for the day. PSU banks also clocked 1.5%. And capital market stocks continue to rise, so 1.6% here as well. If we see in the last 1 month, capital market is up 15%. Of course, nowhere near defense, but 15% on capital market, and real estate also has come back at 10%. So these are some of the more stronger parts of the market. IT lost ground today, minus 1.3%. Defense also, there was profit booking, minus 1.3%. And several other sectors were within plus or minus 0.5% for the day. Real estate, Raymond's, Phoenix Mills, Oberoi, DLF, and Godrej all were doing well. Maybe the market is now pricing in some sort of a interest rate cut come first week of June. RBI is slated to meet for interest rate policy, and perhaps we will see a cut in June. Emphasis, Coforge, Infosys, TCS, and Tech Mahindra were all down. IT stocks all down, minus 1.3% on IT index. Now let's come to the topic of discussion today. So gold is great for non-USD investors. What do we mean by that? So let's look at the gold USD chart. So this is the gold price in USD. Just historically also, it's a very nice chart to see that in the 1800s till 1930s, gold price was pegged at roughly $20, and then it was repegged at near 36 odd dollars, and then it was repriced to 40, 42, and then it was let go. In 1971, President Nixon on August 15th allowed dollar not to be backed by the gold standard, the gold conversion, and the gold took off in that decade. So from 38 $40, we went to straight to $800 in that decade. So 1971 to roughly 1981. And then, of course, there was a correction after this humongous run. There would naturally would want the market would want to have some sort of an equilibrium, which happened. But this equilibrium was extended because several countries like the UK wanted to sell out all their gold. They said we don't want any gold. So there was an extended plan announced that every year we will sell so much of gold in the market, and hence gold never could take off in those 2 decades. And then from 99 2000 onwards, when gold was nearly $250, it again took off, uh, and the GFC was part of this run. And then by 2011, it went from $250 to nearly $2000, again 8 times from where it was. And then there was a few years of correction coming down to $1000, and then from 1000 it is now at nearly whatever 3240 or so. So in USD terms, since it was let loose from here, it gold has given a CAGR of roughly 8.3% in dollar terms, but it has had a very sharp drawdown also of nearly 63% right here. So this has been the statistics in gold. Now, long phases of drawdown, as I mentioned, 63% right here from the peak. Although if you see from where we started, the bottom of this was still much, much higher, almost 8 times higher. And this entire 2 decades of gradual drawdown was very, very painful. Now, the real reasons were, of course, Paul Walker, who was the Fed chair at that time. He hiked interest rates. They went up to 15% in the US because inflation was going out of control. And there was strong US dollar and economic stability post 1980s. So that also reduced gold's appeal as a hedge in the 80s. And in the 80s and 90s, everything was hunky dory in the stock markets, etc. So people were not really looking for any hedge. There was low inflation, strong equity market. So the focus shifted away from gold. Now, if interestingly, during the same period when gold went through a 60% plus drawdown in USD terms, in INR terms, in the same time period, gold was up 72%. That primarily, of course, had to do with rupee getting depreciated very, very badly versus the US dollar. So the idea here is that even when gold is depreciating very hard in USD terms, if our currency is going to take even a bigger beating, then at least we can hedge to that extent of gains in our portfolio. So in the sense that whenever there is a global crisis, USD being the the cleanest of the dirty shirts out there. Let's put it this way. So whenever USD falls, Indian rupee does not really rise against it, at least not so far. Maybe in the next few decades that will change. So you basically have to hide in some place where uh, the Indian rupee component gets adjusted. So, for instance, if there is a local problem, let's say there was some fiscal crisis in India, uh, as it happened in the 1990s, early 1990s. If you were holding gold in India also, you were effectively holding an international asset, which is priced in US dollars. And the conversion is what you get in the Indian market. So you were not holding a rupee asset, you were actually holding a dollar asset. You have to see it from that point of view. That gold's price is, although it is influenced by India's demand because India is a big buyer, yet it is priced in dollars. So this phase when in the very early 90s, where India had to even give up its gold and mortgage its gold. At that point of time, the currency took a very big hit. We went from, I think, 7 rupees to 25 rupees in virtually no time. And that's the time when, if you were holding gold, your purchasing power would have remained intact because the currency is depreciating and you are holding a asset which is USD based. The second drawdown phase was in September 11 to December 15, where US dollar based drawdown was 43%. So somebody in US, for instance, or somebody uh, overseas who was holding it in USD terms would have lost 43% during this phase. Of course, after making 8 times money, but 43% would have gone here. And that was the period where there was taper talk, again signaling, Fed was signaling the tightening after QE, and there was a risk on sentiment. Equities are entering a strong bull market post 2009, so defensives were in the backseat, and stronger USD and deflation concerns were there, and so on. So gold became a secondary sort of go-to asset in that time period. So what happened during that period? So dollar denominated gold went down by 42%, and we lost about 14% during that period. So not so bad actually. So our currency depreciating at least gave us some sort of a nominal cover to what exactly would have happened to our portfolios. So when we compare overall, for instance, gold in USD terms versus gold in INR terms, you'll find that a lot of years where gold has not done so well in USD terms, in INR terms, the impact is lesser. Let's say 1984 is down 20%. In INR terms, it was 6%. In 1981, it was down 33%. In INR terms, it was 23%. In 1988, gold USD was down 16%. In INR terms, it was flat. In 91, 11% down in USD, but we were up 27% in INR terms. Then you had 1997, gold was down 20%, we were down only 13%. Then there are other periods like 98 was down 3%, we were up 6%, and so on and so forth. There are many years like that. So 2013 was another one of them. Uh, in every situation, you are finding that 2018 gold was down 2% in USD terms, we were up 7%. It is very important to understand that even though it makes no difference whether you price it in US dollar or INR terms, it is essentially at the end of the day the same quantity of gold that you're pricing, but it is easier on your mind if you are pricing it in dollar terms and sitting in India, and in dollar terms it is down 43%. When you see it in rupee terms, you'll find that it's down 20%. It won't hit you so badly. A lot of investing actually is about psychology and about reacting. And you know, if one asset in your portfolio, which is supposed to be a hedge to your portfolio, is yo-yoing at 40-50%, you may not be able to hold it. So that is also one of the things to see in terms of the smoother journey of gold in INR terms. So essentially, gold is good for all uh, currencies beyond USD. It is basically a USD hedge. So while investors are there in US dollars also, and they made 8% over the last 50-60 years, CAGR, 8 point some percent. Yet it is basically a tool to hedge against the dollar. So as the talks are right now that dollar hegemony will get over and dollar will basically decline in the next few decades. Gold will likely to do well just for that reason, because other currencies also will go through that anti-dollar phase. So if we see the longer term chart of the last 55 years, you are seeing that gold price, with a base of 100, if we see, has done very well. And psychologically, you would have had a much better journey right here versus seeing long phases of two decades of nothingness here, whereas in rupee terms you would have seen a perpetual growth happening here. Again, on a drawdowns you can see huge drawdown, 70% drawdown in dollar terms, whereas in INR terms you had once 57%, and then in the last 4 decades you've not gone below 30%, and in the last 10 odd years you've not gone below 20% also. So it's very very easy to hold uh, you know assets that have lower lesser volatility. This is another chart from Capital Mind, actually, from 15th of March, and it tells you what is the annualized returns. So in 1970s, the USD annualized returns were 31.6%. That much in that one decade of 31% annualized returns. In India, it was 23.8. Uh, and then in the 1990s, it was negative. In the 1980s, it was negative, but India was still managing a reasonable positive number here. And in the 2020s, so far, 14% on USD terms, 18.5% on INR annualized terms, amazing returns. So overall, for these 55 years, 8.5% on USD terms and 13.3% on INR terms. I mean, could you ask for more in terms of a returns on hedge? And this basically significant of part of it is due to the currency depreciation, and some part of it is because of duties also. But it is primarily the gold move and the move of the currency. So whenever gold rises globally, INR investors gain on both price rise and rupee weakening usually. So India basically has had higher inflation, current account deficit, political uncertainty. So we've had a lot of focus towards gold uh, as a domestic hedge, leading to stronger, long-term buying interest. There were some statistics that 16% of Indian households' assets are in gold. And if I tell you what is the equity holding of Indian households, you'll be surprised. It is about 5%. So India holds about three times more than the equity in household savings. Another statistics I could give you, that entire household investments in equity markets today is about $1 trillion. Our markets are roughly about 4 to 5 trillion, $5 trillion in market cap, and about 20%, 18 to 20% is held by households. So about $1 trillion is held by households. Now, if you compare that to holdings of gold, which is about 25,000 tons, in the last 1.5 years, that gold holding has made a gain of $1 trillion plus. So what we have invested in equity all these years put together has come as a gain in gold in just the last 18 months. That is the kind of wealth creation and at least a feeling of well-being that is coming to gold holders. So I believe, and I've long advocated this, gold is an absolute must for Indian investors because it is a hedge against our own currency. Right now, our currency is reasonably stable, and let's hope that it stays that way. But who knows? In 5 years, in 10 years, what kind of governors will come and govern us? What kind of governments will be there? What kind of policies will be there? You never know, right? So, like in the 70s and 90s, our currency went for a toss, and it could do so again. So, some part of our asset should be kept outside the rupee domain. It can be priced in rupee, but it is getting determined in dollar terms or overseas basically. uh, and also, since India is importing gold, India hardly produces any gold, and we have a 800-ton demand for gold, and RBI also wants a few hundred tons every year now. So global price increases plus currency weakness toward together amplify the return for Indian investors. So the amount of gold that comes in also drives the INR down versus the US dollar. So it becomes like a self-fulfilling cycle. Of course, it is a cultural and financial anchor, so it is deeply embedded in the Indian household, emotional value and financial utility. The beauty of gold is that the poorest of the poor can invest in it, they understand it, and they've understood it for the last 5,000 years. Even where banks have not reached, even where financial assets have not reached, and the returns are there in front of you. 13% odd for the last 50 odd years. And the last point, but the most bigger best point for my hedging perspective, is that it has a very low correlation with domestic markets. So whenever markets are, in fact, it has a very nice inverse correlation, where whenever markets are down, gold is doing up, because when markets are down, FIIs are usually selling, rupees going for a toss, and gold eventually is going up. So during times of crisis, geopolitical tension, as we have seen recently, inflation scares, political instability, is one asset which just you can just feel very secure about, and that's gold. This is an incrementum chart of gold performance in major currencies. So when I'm saying that in all non-USD currencies, it does really well. So just see the numbers in USD, and this is till end of April, so this is more updated. CAGR is 9.9%, and this is the last 25 years CAGR, and this is also almost, I think, similar to S&P 500. I think that is 10.1 or something like that. In euro terms, 9.6%. In pound terms, 10.9%. In Australian dollar, 10.1%. Canadian dollar, 9.9%. Chinese yuan, 9.3%. Japanese yen, 11.6%. Swiss franc, 7.4%. And INR, 12.9%. That is the kind of CAGR people have enjoyed in their local currencies while hedging all their assets in their local currency, because of this unique anti-USD stand that gold has. Every time dollar will be in trouble, gold is likely to shoot up, and that's what we are seeing in the markets right now. So let me know in the comments what percentage of your total net worth is in gold, and what is the reason for that. Do you plan to increase it? If you've not yet opened your account in terms of buying gold, why not? Do let me know your reasons. Thank you so much for watching this, and I'll see you in the next one.